Next question, can you please provide some clarity around double taxation agreements? So for example, if the Singapore rate was 22%, would your Australian tax bill be reduced by the amount of tax you paid in Singapore?
Yeah, the simplest way I can do this to answer a fairly complicated question is just say the double tax agreement, if there is one in existence, just gives the right of one country to tax it over the other. So for instance, if the double tax agreement applies and that rate is a Singapore rate, that would be a situation where the person was in Singapore for more than half the year, had a home in Singapore and earned the money in Singapore. And what that would mean is the double tax agreement would kick in that even if Australia said, oh, we want to tax you, that the double tax agreement would say, no, you don't have the right. We signed an agreement, so you can't tax it. We're just taxing it in Singapore. Now, that's different to if you were living in Australia for more than 183 days and earned money in Singapore. If you're in Australia more than 183 days, Australia taxes worldwide income, and you'd be taxed on that Singapore income, and you would get a credit for the 22%. So they are two different things. So it comes down to, are you in Australia currently more than 183 days or not? Wherever you are, the majority of the time has the right to tax, right? But if you are in Australia and you earn overseas income, then you would get a credit for any tax paid. So you would only pay the extra. You wouldn't pay Australian tax and the 22%. You would just pay Australian tax less whatever was paid overseas. So you'd pay the difference.